Welcome to csstudents.com, a learning portal for company secretary students. Presentation on the Directors and Managerial Remuneration under the Companies Act 2013. Part 1. The new Companies Act was partially enacted on 12th of September 2013, and majority sections became effective from 1st of April 2014. Under the new Act, the basic provisions relating to the directors and managerial remunerations are similar to the old Act. However, there are some changes also. In this presentation, we would discuss the legal provisions and practical aspects of managerial remuneration under the new Act. With regard to remunerations, the Companies Act provides different provisions for directors and managerial positions. Also, there is no single section which governs the remunerations aspects. One section provides about the limits based on the profits of the company. Another provides for computation of profits for the purpose of calculating the limits. There is a schedule also, which provides the limits if profits are insufficient or nil. So, for easy understanding of remuneration provisions, we classify the directors and managerial personnel in the following categories. First category includes managing director, whole-time directors, manager, and this category may also include the chief executive officer. Second is director, other than managing and whole-time directors. Every category has a remuneration limit under the Companies Act, and the remuneration paid to such category cannot exceed that limit without compliance of certain other provisions. But, for the purpose of remuneration, the position of Chief Executive Officer is little unclear. This position may or may not be subject to the remuneration limits, depending on the work profile. Additionally, these limits and restrictions on remuneration are applicable only on the public companies. Private companies are free to pay remuneration to their directors or managerial personnel. Let's discuss each category. First category: managing director, whole-time director, manager. This classification may also include CEO, depending on his work profile. Managing director, from the perspective of business. Person who is a director, plus having the powers to manage the company. Legally, this power to manage may flow from the Articles of Association of the company, or under an agreement executed by the company, or through a resolution passed by the members, or through a resolution of directors. Now, we see the legal definition of managing director. Section 2 subsection 54 says, managing director means a director who, by virtue of the articles of a company, or an agreement with the company, or a resolution passed in its general meeting, or by its board of directors, is entrusted with substantial powers of management of the affairs of the company, and includes a director occupying the position of managing director, by whatever name called. If we analyze this legal definition for becoming a managing director of a company, the first condition is, the person should be a director. If the concerned person is not a director, he cannot be a managing director. Means, as per the legal definition, the directorship is mandatory for becoming a managing director. The person may be a director appointed by the shareholders, or appointed by the board as additional director, or under casual vacancy. The precise point is, he should be a director. The second, this director should be entrusted with substantial powers of management of the affairs of the company. When we say substantial power, we mean fairly large amount of power or authority. Practically speaking, he has all the executive powers to run the company. The third is, such power of management is coming by virtue of, either from the articles of the company. For example, if one of the provisions of article says, the managing director of the company shall be entrusted with the substantial powers of management. Alternatively, powers can come by virtue of an agreement. For example, the company enters into an agreement with one of its director, say Mr. X. And the agreement provides that Mr. X shall have the substantial powers to manage the company. Mr. X shall become the managing director, as per the definition given in the Act. The power of management can also come from a resolution passed in the general meeting. Means, shareholders pass a resolution to give substantial powers to manage the company to one of the director. Or, the board can pass a resolution to give substantial powers to manage the company to one of the director. In both the cases, that director shall be the managing director. Additionally, the definition also includes a director who occupies the position of managing director. Means, if your company has designated one of its director as managing director, he would become managing director under the definition. The implication of someone becoming managing director is his remuneration must be strictly within the limits specified under the Companies Act. The first category also includes the whole-time directors. The definition of whole-time director is given in Section 2 subsection 94. As per the definition, the whole-time director includes a director in the whole-time employment of the company. So, the given definition is an inclusive definition and primarily covers any director who is in the whole-time employment of the company. For being in whole-time employment, one needs to have an employment contract with the company. Legally, employment contract means contract of service. Therefore, for checking someone's status as whole-time director, please check the nature of the contract between company and that director. If the nature of that contract is a contract of service, then that director shall be a whole-time director. For example, if Mr. X is a whole-time employee of the company, and, being the head of the finance department, he is inducted in the board, and designated as Director Finance, he shall be a whole-time director, and his remuneration shall be subject to the limits mentioned in the Companies Act. Also, please note that the definition of whole-time director is an inclusive definition. Therefore, this definition may cover other categories of directors based on the facts and circumstances of each case. The next position in the first category is manager. Under the Companies Act, the manager is defined in Section 2, subsection 53 as manager means an individual who, subject to the superintendence, control and direction of the board of directors, has the management of the whole, or substantially the whole, of the affairs of a company, and includes a director or any other person occupying the position of a manager, by whatever name called, whether under a contract of service or not. So, if the person is an individual, he is working subject to the superintendence, control and direction of the board of directors. Means, there should be a direct reporting to the board. Then, the person has the management of the whole, or substantially the whole, of the affairs of a company. This is the most important point. Basically, for being a manager, the person should be the executive head of the whole, or substantially the whole, of the affairs of a company. Additionally, if some person is occupying the position of manager, he shall automatically becomes the manager under the Companies Act. And such person may be a director, or not. Means, unlike the position of managing director, the manager is not required to be a director. The last point in the definition provides that the manager could be either under contract of service or not. Means, the manager may or may not be under the employment of the company. So, for being a manager, the employment contract is not mandatory. However, in practical life, in most of the cases, the manager is in the employment of the company. Now, we would discuss the position of the Chief Executive Officer. Chief Executive Officer is an American term which denotes the executive head of the company. A Chief Executive Officer is generally the senior-most corporate executive in the company's hierarchy. The new Act provides the definition of Chief Executive Officer. Under the Companies Act, 2013, as per the definition given in Section 2 subsection 18, Chief Executive Officer means an officer of a company who has been designated as such by it. So it's a very open-ended definition. The definition only provides that, if the company has designated one of its officers as Chief Executive Officer, the law will also deem that person as Chief Executive Officer. One quick implication of being a Chief Executive Officer is that person would become the key managerial personnel, as per the definition given in the Companies Act. And the position of key managerial personnel is covered under the definition of officer in default. Generally, the officer in default is a person who shall be liable for fine and penalty if company violates any provision of the Companies Act. So, if there is a Chief Executive Officer, he becomes officer in default and shall be liable to face action for any violations by the company. Now, we discuss remuneration-related implications of the Chief Executive Officer. Here, we are going with the presumption that the Chief Executive Officer is not a director. The new Act does not expressly provide any remuneration limits for the position of Chief Executive Officer. Then, in what scenarios position of Chief Executive Officer would be subject to the remuneration limits? We know that the manager's remuneration should be within limits. Therefore, if the profile of Chief Executive Officer is similar to the definition of manager, his remuneration shall also become subject to the limits mentioned in the Act. So, if Mr. B is designated as the Chief Executive Officer of X Limited, and he works under the supervision of the Board of Directors. Also, he has the management of the whole, or substantially the whole, of the affairs of a company. With these two parameters, he becomes manager under the Companies Act, and his remuneration must be subject to the remuneration limits. However, if Mr. B is either not working under the supervision of the board, or, in spite being designated as Chief Executive Officer, he is managing only a smaller part of company's activities, and not looking for whole, or substantially the whole of affairs, he shall not be a manager, and his remuneration shall be without any limits. It's a tricky interpretation, and final call should be taken only after a proper analysis of facts and circumstances. This was the discussion on Manager and Chief Executive Officer. So, positions covered under the first category are the Managing Director, the Whole-Time Director, and the Manager, which may include Chief Executive Officer also. Now, we discuss the second category. The second category covers directors other than managing or whole-time director. In other words, non-executive directors. Basically, the directors, though part of the board, but hold no executive post. This includes normal directors, independent directors, and in most of the cases, nominee directors. For example, if X Limited has 6 directors, out of which Mr. A is managing director, Mr. B is a whole-time director, and other 4 are just directors. Mr. A and Mr. B shall be covered under the first category. Other directors shall be covered under the second category. Now, we discuss the remuneration limit of both the categories. Conceptually, remuneration for both the categories is linked with the annual profits. In this regard, Section 197 of the Companies Act says, the total combined remuneration of both the categories for a particular year shall not exceed 11% of the company's profits for that year. Means, the aggregate remuneration of the managing director, whole-time director, manager, and other non-executive directors for a particular year cannot be more than 11% of the company's profits for that year. Section 197 also says that, for this purpose, profits shall be calculated as per Section 198, and managerial remuneration should have not been deducted from that. Therefore, for the purpose of calculating the remuneration limits, Section 198 provides the method of calculation of profits. You cannot simply take the profit figure from the concerned year's P&L account and apply 11% to calculate the maximum remuneration. If we look at principally, managerial remuneration is an expense for the company. Therefore, while determining the profits in the regular P&L account, like any other expenditure, the managerial remuneration will also be deducted. However, for the purpose of Section 197, while calculating the profits, the managerial remuneration should have not been deducted. Means, if managerial remuneration is already deducted from the profit figure you have, then add it back to your profit to calculate the available profits for managerial remuneration. Let's understand with an example. Based on the method provided in Section 198, X Limited's profits for the financial year 13-14 is Rs 1 lakh. After deducting all the expenses including managerial remuneration of Rs 10,000. So, the overall permissible limit shall be calculated as follows. Profit as per Section 198. 1 lakh. Add back the managerial remuneration paid and already deducted from the profit. 10,000. Adding both of them. So, the base profit for calculating the permissible managerial remuneration is 1,10,000. Permissible remuneration limit is 11% of the base profits, which comes to 12,100. So, X Limited can pay up to Rs 12,100 as aggregate remuneration to its managing director, whole-time director, manager, and other non-executive directors. Payment of remuneration in excess of 11%. The proviso to subsection 1 of Section 197 provides that the company in general meeting may, with the approval of the central government, authorize the payment of remuneration exceeding 11% of the net profits of the company, subject to the provisions of Schedule 5. So, more than 11% could be paid, with the compliance of two conditions: approval in general meeting and approval of central government. But, this flexibility to pay more than 11% is subject to the Schedule 5. If we look at the Schedule 5, it does permit to pay more than 11% without the central government approval. But such remuneration must be within the limits mentioned in the Schedule 5. So, if we summarize the provisions of maximum remuneration limits, if the company has adequate profits, it can pay up to 11%. If company has no profits or inadequate profits, it can pay more than 11% but within the limits mentioned in Schedule 5, without the approval of central government. If company has no profits or insufficient profits and it wants to pay more than 11%, as well as more than the limits mentioned in Schedule 5, it has to approach to central government for approval. Therefore, any company wanted to pay more than 11% has two options. It can choose to go to the central government, or it can pay remuneration under Schedule 5 to the Act. Schedule 5 is corresponding to Schedule 13 to the old Act. It provides various limits, up to which the company can pay the remuneration exceeding 11%. Distribution of 11%. Coming back to our original limit of 11%. Now, the question is, how to distribute this 11% of profits? Managing directors, whole-time directors, or managers, are the executive heads of the company. They put maximum efforts to run the company's business. Therefore, they shall be entitled for a combined higher share of 10% of net profits, subject to singly getting maximum 5% of the net profits. Means, all managing directors, whole-time directors, or managers, put together, will get maximum of 10% of net profits. And, single managing director, whole-time director, or manager, will get maximum 5% of the net profits. And, to determine the percentage limits for non-executive directors. First check if the concerned company has any managing director, whole-time director, or manager. If yes, all non-executive directors, put together, will get 1% of the net profit. If company has no managing director, whole-time director, or manager, all non-executive directors, put together, will get 3% of the net profits. The provision of Section 197 deals with this. It says that, except with the approval of the company in general meeting, the remuneration payable to single managing director, whole-time director, or manager, shall not exceed more than 5% of the net profits of the company. The cumulative remuneration payable to all managing directors, whole-time directors, and managers, shall not exceed more than 10% of the net profit. For non-executive directors, if the company has any managing or whole-time director, or manager, the cumulative remuneration of all the non-executive director cannot exceed 1% of the net profits. If the company has no managing or whole-time director, or manager, then the limit or non-executive directors goes up to 3% of the net profits for that particular year. In case of certain companies, directors are also entitled for sitting fees. So, should we include that payment also in the above limits? Subsection 2 of Section 197 clarifies that aspect. It says that the percentages aforesaid shall be exclusive of any fees payable to directors. Means, any payment made as sitting fees shall not be included as remuneration for checking the limits. Legal provisions under subsection 5, relating to sitting fees. Director may receive the sitting fees for attending the board, committee or other purpose, as may be decided by the board. So, the board has the power to decide whether to pay the sitting fees or not. Or if to be paid, how much to be paid, subject to the prescribed maximum limit. Means, the board has the power to decide in what scenario director shall be paid the sitting fees. But, amount of such fees shall not exceed the limit as prescribed by the Ministry of Corporate Affairs. Amount currently prescribed in the rules is ₹1 lakh per meeting. This rule also provides that the sitting fees payable to independent directors or women directors shall not be less than the fees payable to other directors. Means, no discrimination with independent and women directors. In this first part, we discussed the broad categories of managerial personnel for the purpose